One of the biggest fears for someone approaching or just about to retire is the point at which they begin drawing down on their pension pot, the pension that they have potentially spent decades building up. And there's at this point at which hopefully they have some idea as to the value of the pension and to the likely amount that they will need to take out as an income to be able to provide them with the standard of living that they are after. Now, the two key risks at this stage that any retiree has to contend with is the percentage that they are looking to take from their pot to ensure that it is sustainable and doesn't run out, and the potential risk of significant volatility in those early years of retirement known as sequence of returns risk. Now, Will Bengen did some research into this, and he's well known for his research into the safe withdrawal rate, in which he looked back at various time periods to see what impacts certain asset allocations would have on a client's retirement, and also how the volatility at various points in someone's retirement would impact the chances of their fund running out. Now, there are really two schools of thought to this process. One is the probability-based model, which tends to focus on the historical performance of markets over very long periods of time, and then assumptions are made as to what sustainably can be taken and the asset allocation required, this being Will Bengen's area. The second is the safety first approach that would assume someone uses low risk assets, annuities, and defined benefit pension schemes to provide secure income that is not reliant on the stock market. The issue for most retirees is that it will be unlikely that they will have enough value in their pension fund, enough money there that will buy themselves a secure income that increases with inflation and that provides any kind of value on death. The demise of the defined benefit pension scheme also means that individuals are pushed further into the probability-based approach. The probability-based approach is really drilling down on likely outcomes, on weighing up and taking a calculated risk. The variability of future outcomes is huge, but we have to base the future potential of an outcome within the parameters of what would be considered reasonable. So is what we are looking at reasoned and reasonable? The conclusion that Will Bengen got to, having looked at various periods of time and asset allocations, was that depending on the asset allocation and the period of time in question, there is a percentage amount from which can be drawn from the fund that is arguably sustainable and that was possibly oversimplified into the 4% rule. And then after subsequent research completed later, it was 4.5% rule, which is based on a minimum of 30 years of longevity using a portfolio made up of 35% US large cap stocks, 18% US small cap, and 47% intermediate government bonds with yearly rebalancing in place. Essentially a 50-50 split between bonds and equities. What he did also highlight alongside the safe withdrawal rate was the relevance of sequence of returns risk. And I can demonstrate an example of what this can look like using our trusty old Cashflow planner and Mr. Pickles as an example. He's got a £500,000 pension pot, keeping it really super simple, and he's taking out £20,000 per year, which is in line with the 4%, and he's growing this pot of money at about 6.5% per year. So we know this is, broadly speaking, going to be sustainable. Now, the reason you can see this is actually declining slightly each year because we've got 2.5% inflation rate, we've got 6.5% growth rate, which is lower than the average as per the data from Vanguard as to what a return of a 60-40 portfolio has got on average over a 100-year period. So 6.5% growth rate, which means a real rate of return of 4%. But the reason for the decreasing amount each year is because the £20,000 income that he is taking is going up by 2.5% each year with inflation. So he's keeping the real purchasing power of that money. So in effect, we are actually just slightly decreasing the value of that pension pot over time. But as you see, it's perfectly sustainable. We can even stress test that with the Monte Carlo simulation, and I'll just bring that up on the screen now. So what we're doing here is we're just literally looking at really wanting to assess the likelihood, the probability of this fund dropping below zero at any given point in time. And effectively we can see with this simulation that we get 87.1% of the simulations stayed above zero. So there are some scenarios where obviously this does drop over this period of time, up to 99 years, below zero. So you can see those outliers, the very upper end and the very lower end. Obviously this is seeing huge returns year after year or huge declines year after year. But broadly speaking, on average, which is that blue line, you can see that it's pretty consistent and that's a relatively sustainable level of income based on these assumptions. So what I wanted to show you was just what a market decline looks like in those very early years of retirement for Mr. Pickles. So he's retiring at age 58. He's under the age of 40, let's say. So he's basically, his personal pension age, the age at which he can access his personal pension, is going to be age 57. Currently it's 55, but in this case it's 57. And he's going to start drawing down on his pension from 58. Now, as soon as he hits age 58, the fund actually drops by 15%. So he has a 15% market drop. Now, bearing in mind that back in March of 2020, we had a 30% decline on the UK index, on the FTSE 100, a 15% decline really wouldn't be out of the question as far as if it was a more diversified, balanced portfolio, obviously including bonds, etc. So effectively a 15% decline, he gets hit with that. He then gets hit with a further 5% decline in the following year and a -2%. A 0, and then it starts growing back again at the same rate at 6.5% a year, which means by 83, in effect, he's run out of money. But what I've done here is then just having a look at what this looks like if this decline was to occur later on. So let's say it's 10 years later, approximately age 67, he has a -15% decline, exactly the same basis. Still has an impact, not as dramatic. It gets him to age 90. So there is a significant difference in terms of obviously that decline appearing or happening later in retirement as opposed to at the very early stages of retirement, which means he gets to about 91 before he actually runs out of money, with those declines occurring later on in retirement. So not as bad, but still not ideal. Now this is looking at the scenario where if he was to actually take out the tax-free cash, so he's got 500,000 cash and park it in a cash account and use that to draw down as his income. This means obviously during this period of time, the fund is then getting that ability to recover, but not to the extent that you would like. What's happened here is that these market declines are quite severe and we never really get that full recovery before we then start need to be drawing down on that money again. So this is where we have an issue where the cash really isn't sufficient quite enough to cover that period of time when we need it to then fully recover. So we end up in the situation where, despite having taken out that cash, that big chunk of cash that we're then using as our drawing our income from it, it's still not quite enough to cover us for that period of time. So therefore, we still end up in the position whereby age 85 that the fund still doesn't last. However, what I do want to show you is just an example of actually that same scenario, but actually putting in the financial crisis and recovery of 2007 to 2012, the banking crisis, and applying that to this situation. Because what's happening here is that we have a very, very severe drop in value of 35% in the value of our fund, and then a big increase in the subsequent year of a 40% increase. Now, it's not getting us back to quite where we were, but it does mean the fund actually does last a little bit longer, because what we're able to do is we are using that cash up that we took out as our tax-free cash, and we're using that to provide us with the income. And now then, because of that decline and then subsequent rally in the value of our fund is both severe on the downside and dramatic on the upside, it means within that period we're actually able to sustain a decent amount of recovery to allow it to recover from where we can then start drawing down our £20,000 a year. But as you can imagine, when you're looking at this is a fairly painful experience to go through. And I remember this very well back in 2008 when we saw those significant declines and the impact that has on pension pots, and then the impact that has on the individual as far as how they feel about it when they're seeing their pension values dropping by significant amounts, and the fact that they're taking an income from that as well. They're reliant on that pot of money for income. So we'll talk a bit more about this later in the video as to some of the ways to think about this and some of the ways you might be able to mitigate it as well, and really the options that are available from there. We know that drops in the market have historically been rapid and emotionally driven, and double-digit plunges on average last about 192 days, with rallies being slow and gradual. The old phrase I remember well is that stocks go up the escalator but down in the lift seems to largely being quite true. Now, falls in the market occur rapidly, which makes it almost impossible to get out before the falls have already occurred, and gains seem to sneak up on us over time. One really interesting piece of research I wanted to highlight was from the US University MIT that found the most likely demographic to, as they scientifically put it, freak out and panic sell are married men over the age of 45 with dependents, and that would self-identify themselves as having excellent investment experience or knowledge. Now, what was really interesting from this was that those that did panic sell, 30% never returned to reinvest in risky assets, and that the median investor, having done all of this, earned a negative to zero return after the panic selling. So it was a complete waste of time. Sorry, a bit of a digression there. So on balance, sequence of returns risk can be managed in the following possible ways. If the fund value was to drop, then a reduction in income will help support the fund value, and essentially you'd have to await the recovery. This will be far less damaging to the portfolio, but with the obvious negative impact on income levels for a period of time being reduced. What's interesting here is that Will Bengen advocates potentially increasing risk as the stock market falls, whether moving up the equity allocation from 50 to 75% or 75 to 100 to give a far greater chance of higher returns in the future. But realistically, someone doing this is very low given our typical investor behavioral biases, meaning we are likely to want to take less risk or even moving to a more cautious position, which arguably would be the worst thing to do after a significant market drop. Realistically, and this could be considered controversial, then if someone really cannot stomach the volatility, then using an annuity should not be out of the question. Securing a known level of income with some of the fund can be a valuable benefit, which is then completely uncorrelated with the remaining pension fund. Certainly a base level of secure income can be a beneficial thing to do from which you know your essential costs are covered. Definitely has some merit to it. Holding a buffer of cash that will provide an income for a period of time is certainly a workable solution, and arguably gives the portfolio that chance to recover its losses, or allows the percentage of withdrawals to be reduced from the fund whilst maintaining the same level of income. Clearly the downside here is that you give up those potential returns on the cash holding, and you are reliant on the cash holding lasting long enough for the period of the recovery. We also have to bear in mind that the sequence of returns risk could just as equally work out in someone's favor, and that they enjoy significant market returns in the early years of their retirement. In that case, you would argue that the cushion of increased assets that's being built up should be seen as a support for any future reversal and declines that might well occur. As Will Bengen himself admits, the 4.5% rule works for now, but that it will still come down to individual circumstances, attitude to risk, to volatility, and the capacity that someone has for loss. But it will essentially guide them as to what is suitable for them. You cannot simply take one rule and apply it to every situation, as it simply will not be appropriate. Thank you so much for watching, and I'll see you again soon. Bye.